going to be talking about like navigating a new frontier, capital development opportunities in emerging markets. We have, I was thinking before, if you guys want, I can introduce yourself, but I think you guys can also kind of introduce yourselves, talk a little bit where you're from and what you do. And who's our first? Oh, you can serve first. Actually, I forgot. Thank you.
Hey, hi everyone. My name is Luis Ballesteros. I'm originally from Mexico, just because you asked. I think we need the mic for this.
Wait, Omar, can you hear without the mic?
Can you hear us?
I can hear you.
Okay.
Okay.
All right. So
The background is killing people.
yeah, that's fine. I'm a professor at the Question School here. I actually teach 2 rooms from here. I mostly do research. So my research is on how companies deal with uncertainty, especially the type of uncertainty shocks that now you see, like natural disasters, financial crisis, but geopolitical uncertainty, wars. And I'm really interested in that because I feel that the way that companies manage uncertainty really have to do with competitive advantages and who wins in the market. And at the same time, we are really ineffective at managing uncertainty. So I'm really, really fascinated understanding what factors matter for that skill to develop.
And so I come from it from a different perspective. I actually grew up with a lot of uncertainty and a lot of instability. And later on, I built a real estate portfolio from scratch and spent my time right out of college, worked for Goldman Sachs investment banking. Then I also worked for a long-short equity hedge fund, $3 billion hedge fund in the Boston area, covering European financials, U.S. home builders, UK home builders, and U.S. financials. And so I have been able to see things from 2 sides, like when you have systems that actually don't work, and also when you go out and build something that actually does. So when I think about development, especially in emerging markets and investing in those markets, what I'm actually thinking about is how do we actually deploy capital, sustain capital, and also scale it over time.
Cool. That's pretty cool. Omar, you can go.
Yes. Hello. Yes, my name is, you can hear me?
Yeah. Yes.
Can you hear me? Okay. My name is Omar Abdul Razak, as you can see. I'm the former ambassador of Maldives to the European Union and Belgium and Sri Lanka, and also the non-resident ambassador to South Africa, Australia, Kazakhstan, Qatar, Seychelles, Mauritius, I would like to first take this opportunity to thank the Boston University International Affairs Association for inviting me to join this panel. I was to be there in person. Thank you. However, flight scheduling from this part of the world to get over there is becoming an emerging challenge, emerging problem in this fracturing or rather fractured world. Anyway, what I would like to say is that Maldives, as much as we would like to promote bilateral and multilateral diplomacy, we also encourage commercial diplomacy. So, which includes countries, which includes in the emerging markets as well. So, to discuss further as we go on. Thank you.
Thanks, guys. I also kind of want to start off with acknowledging the fact that kind of each of you guys have different perspectives, one more an academic perspective, one a more private perspective, one a more diplomatic perspective. And how do each of you guys see the new frontier in emerging markets and each of your guys' unique perspectives? And what does it look like today? And maybe how has it changed differently in this past decade?
Okay. That's a good question. I think that the reason that it's a good question is how do we define emerging markets at all? This time is really not that simple, right? Because what we are seeing is a set of forces that are coming from places that we used to call developing, that are really changing the way we think about businesses and the way that we see opportunities at the international level. And I think that that's by itself probably the most important development in the last years, because it's not only China, but it's also a set of practices and understandings about how the world can work in different places that really is transforming how we approach opportunities, business opportunities in different places. And this has to do with the way we think about institutions, as you mentioned, right? Like institutions, we used to think about the fact that better institutions, more institutional development is good. Like no matter what happens, it's good. Like having a society where property rights are established in regulation, when you have certainty about the government and things like that, it's something that we used to read in textbooks, and that drastically has changed, right? Especially we see where we are right now, a country that is going in probably in the opposite direction in so many ways, and that's something also affecting how we perceive opportunities in emerging markets, and that's together is a really big development that if we were in this room 10 years ago, would be a completely different situation. And just by itself, if you think about it, is for business leaders and policymakers, just facing that new reality entails a lot of ambiguity.
Yeah. Like when I started my career at Goldman Sachs in 2005 in New York doing investment banking, merger and acquisition, financing deal, industry work, it was the buzzwords globalization. And we used to talk about like the BRICS, Brazil, Russia, India, and China, where we're trying to figure out, are they going to be successful? Is this growth going to be sustainable? And then you have like the Great Recession or what have you, and everybody was like, we want to open our borders, we want to work with other communities. The United States was like, okay, we want to bring in immigration or what have you, George W. Bush or what have you. So, and what now, it's in many respects, policy change, where, and you also had the Eurozone, as I used to, and you had the UK was a part of the Eurozone, and now they have decided to separate. So over the past 20 or 30 years, things definitely, you have a lot of uncertainty. And so it makes it a lot harder to just say, all right, we have this predictability, and we know the policy is going to be this way, so we're going to go that way. So as we think about, in many respects, a lot of us say we want to avoid risk. The main thing you have to do is understand that risk is just mispriced. So once we can really understand risk in these different markets, you're going to have inefficiencies around with it's going to be infrastructure, housing, and access. That means access to education or capital. So your job, where you have these gaps, that's the opportunity. And so if you can understand the risk, that's how you're going to make your money. And that's what I did. My background growing up poor with my mother raised 7 children on welfare, barely keep the lights on. And it was a point where we lived in a studio apartment where we had a hot plate, no stove. We had a bathroom sheet, no bathroom door. We had a bathroom tub and no shower. And 15 people living in a studio apartment competing with rats and roaches. And I mention that because I had to assess this situation that people didn't want to invest in. So I changed my life around and was able to go back and start investing in a neighborhood. Now I own over 160 units. It's because I can assess the risk. And so I think in this market, we have to take these things that people may say is a little fuzzy or we can't understand and be able to say, you know what, I can come with this angle and I can make money off of it, or I can have an impact in terms politically. So when I think about emerging markets, what happened now is that the fundamentals are the same, the variables have changed. And so the best way we can equip ourselves is going to conferences, talking to experts, and bringing it all together to say, all right, I understand the local dynamics, I understand the culture, I understand the regulations, and now I'm going to place my bets.
What's that?
Sorry. Omar, you hear us? Sorry, I don't know if you cut out. Maybe talking to some. Yeah. Okay. Yeah. Come on.
Yeah, sure. Yeah.
Do you hear me now?
Oh, yes.
Yes.
Sorry.
Do you have anything to add on that first question? Sorry, I just don't.
Yes, yes.
Sorry, my bad.
I think that's a valid question. If you were to understand the new frontiers looks like in the emerging markets today, we need to understand what it looked like yesterday. And in traditional markets, we refer to economies transitioning towards high industrialization and stronger financial systems and greater global integration. Because the new frontier, they offer opportunities such as rapid economic growth and expanding middle classes and untapped investment opportunities. Of course, the capital in emerging markets used to flow from foreign direct investment and private equity and venture capital. Navigating the frontier requires, of course, awareness of regulatory uncertainties and currency fluctuations. And what my colleagues, they also said, more importantly, political instability or global policy shifts or geopolitical scenario today plays an important role. And the big shift today is it's moving from globalization to fragmentation. We are no longer in a fully globalized world, but there is a rise of selective globalization. Capital is becoming more regional and political and strategic. Capital is not scarce, however, confidence is. There is trillions of dollars in global liquidity, but it's very selectively deployed. Investors are not really asking where is the growth, but where is the certainty. So the real challenge is de-risking perception, not just improving the fundamentals. So emerging markets are no longer just growth stories, they are now supply chain anchors. Not every emerging market will benefit equally. Capital doesn't just ask how do I enter, but also how do I exist. So the main difference is that capital is now selective and politically aware, execution is more complex, and the risk is structured rather than ignored. Thank you.
Thank you. And actually, I just wanted to ask a quick follow-up to all of you guys. Really great answers. And I think one thing that kind of stood out is this idea of regulation and how regulation is enforced domestically, internationally, and even how regulation can be imposed through industry and through companies. And how do you think that plays a role into emerging markets in the future? As maybe, you can cite some examples in the U.S. have maybe loosened in some aspects. For example, like just our fireside chat with AI regulation and data privacy, and maybe some more institutional or long-standing regulation that maybe has even strengthened.
Well, I think regulation is another hot topic, right? Because the way that you think about regulation is setting a bounding constraint to what you can do, what you cannot do, and that's really important for companies, right? And how attractive markets are, because the reality of this world, and by the way, it's not that we go from globalization to immediately a fragmented market that works like that, right? Like in reality, we're still highly connected. We depend on each other. And that matters because the way that we perceive these opportunities in markets depends a lot with what you can do in different countries. And take the EU, right? You were asking for an example. The EU is very stringent in regulation, right? And that matters for the ability of different companies in the region to develop. And what you're seeing is that given this stringency in regulation, these companies are having a disadvantage to develop, not only at the international level, but also to compete inside the region.
Yes.
And what you have is more flexibility that's coming from other places. The US, for instance, right? There's so many things that we need to discuss about about what has happened in the US. Oh my God, so many things, right? But one thing that has happened is liberalization in many industries. Whether that's something that we like or not, it has mattered for how we cope with shocks like the ones that we are seeing, like tariffs, for instance. One of the reasons that we don't see an impact in consumers in many industries is because we have a regulation that is more lax nowadays than just 2 years ago. That matters, and the argument for regulation or no regulation is something that is dynamic. It doesn't really comes a point when we say, okay, we have the optimal amount of regulation in this given place, let's just grow. In reality, you have to perceive what
Yeah.
the war is and adapt your regulation to that. And the problem with that is that regulation is and regulators are not as dynamic as the opportunities
Always.
and the challenges that we're seeing at the international level. So this creates also this dynamic of, oh, there are other places in the world that probably are going to develop faster because they have different approaches to regulation, which is not necessarily good, right? Because we have environmental problems, human rights
Yes.
problems that don't happen, for instance, in the EU, right? So there's a lot of trade-offs that we need to consider because at some point we need to balance how much we can achieve from the social good versus how much we foster private wealth
Yeah.
and private opportunities.
In many respects, what you, as an investor, if you're thinking from a big corporation or whether a hedge fund or a private equity person, what you're trying to assess is what is the base case scenario here, what is the worst case scenario here, and the best case scenario here, and then we're putting probabilities on there, and the probabilities need to add up to 100%. And so nothing is perfect. So we come up with like a grid, and we were like, okay, this is the culture, we get a certain amount of points. This is regulation, we give a certain amount of points, because you're trying to stack the odds in your favor as you're thinking about these different environments. So you may say, if I'm investing in tech, let's say in technology in the EU, and I see that they have, the regulation is not that free, they're not really pushing or developing there, so I'm gonna dig them for certain points. But I may say, look at the US, I like this aspect of it. Or I may decide to invest in this developing country in Nigeria or Ghana because they have these raw goods, and I know that I'm looking at the political leadership, and what I really want as an investor is I want them to be consistently right or consistently wrong. I don't want it to keep changing because it makes it hard for me to do my 3-year projections, 5-year projections, 10-year projections. So I am trying to get a sense of where do they stand with regard to some of the superpowers, also some of the regional powers, because as an investor, the first thing we care about is return of capital. I want my money to come back to me, and then I want to focus on the return on capital. So that investor is not necessarily always thinking about like the social issue all the time or thinking about what's good for the greater good. I'm just being honest with you. We're trying to figure out, all right, I have this capital, I'm trying to deploy it in the most effective way so that I can achieve my goal. And so I think if you are policymakers and if you are government officials, you sometimes have to make the case to the investors because they get nervous. Like in the Middle East right now, some people will say, I should have never invested in like Dubai or some of these places because I didn't put enough weight towards the risk factor that a war can happen. Because they're like, that's a place that won't be touched. So as you guys are thinking about these issues, you want to say, all right, and if you may say, I want to do infrastructure in a certain city, if you're on the policy side, think about how can you monetize that or win someone over that has the capital, whether that's the big corporations or the superpowers. It's like you were saying, it's a lot of different factors. You're trying to get the local people, the international community, and you hear this inflows and outflows of capital.
Omar, you can go next if you.
I'm sorry, what was the question again?
Oh, sorry. It was just like a follow-up on that.
Yeah.
Sorry. It was just like a follow-up on the previous question on. I think that's the next question. I blank.
Okay, I'm talking about institutions and regulations.
Yes. So basically, it was like a follow-up on how regulation plays a role in emerging markets.
Okay, well, actually, I believe institutions ultimately and regulations matter more than the resources and demographics, but not always in the same stage of development. You can actually see sometimes rapid growth in environments with weaker regulations, institutions, especially if there are strong resources and favorable demographics or a clear demand driver like tourism. So for example, in the Maldives, the growth of tourism, it came to the private sector. There is not much interference by the government or regulations, but however, over the long term, institutions are what actually convert opportunity into consistency. They provide predictability, enforce contracts, and reduce friction. So regulations, institutions don't always stay there. start the growth story, but they decide how long it lasts or determines whether it lasts. So the real trajectory is resources and demographics can start the growth story, but institutions, regulations are the determine whether it lasts or rather decide how long it lasts. Thank you.
To kind of add on to your point, Omar, how important are institutions relative to resources and demographics? For example, if a country has good demographics, good resources, and good capital investment, but poor institutions, is it possible for a time at least for that country to still develop, because the institution development will come with capital and resources and everything like that?
You can go first, Joe.
Yeah.
Hello? Sorry. Wait, did you hear the question? We can
I
restate
think
it.
you have to use the microphone for
Yeah, yeah, I think so. Sorry. That's
Let me restate. Yeah. Hello? Yeah, sorry, Omar. Yeah, just to add on to your question, how important do you think institutions are relative to resources and demographics? Like, for example, can a country with good resources, good demographics, and good investment still be successful, at least for a time, with weaker institutions? And how do institutions and capital investment kind of support each other?
Yes, as I said earlier, I was just giving an example of my country, how when tourism started back in 1972, of course we had a very natural beauty and the resources were good, and the government at that time did not think that the Maldives was a destination for tourists. In fact, when the pioneers approached the government at that time, they laughed it off. They laughed 1 week at the president at the time. They thought that it was the most stupid thing that anyone can even suggest. But however, tourism started back in 1972, and yes, the private sector was solely responsible for taking it forward. But however, when it starts booming, when it starts, catching wind or going well, suddenly you need institutions, you need government support, you need to have all that in place. Otherwise, you cannot actually grow. So basically, for an industry to grow, we saw that happening right in front of our eyes in the Maldives, and you need the regulations. You can go to a certain point, but after that, you cannot maintain it. Thank you.
I agree.
Yeah. Do you guys have any?
I agree with you.
It's comprehensive. What we'll do now is we want to also have a couple of individual questions for each of you guys, because I know you guys all have really interesting perspectives on that idea of emerging markets. And so we'll start first with Luis. From your perspective, are investors still using outdated frameworks to assess risk in emerging markets, as risk is almost synonymous when looking at emerging markets, and especially when disruption is becoming the norm rather than the exception?
Well, there are two things, right? Like, one is risk. I mean, risk is risk. You can use any model and at some point capture risk if you have the data. The problem is uncertainty, right? Which is the source of most of the complexity that business leaders are facing right now. And I think that it's not a matter of emerging markets versus institutionalized or highly developed markets. It's a matter of, we don't really have instruments, and you know this because you were in the financial sector. We don't have instruments to hedge uncertainty.
Yeah.
And that's something that is really important, because the institutions don't really matter if you don't have the ability to have certainty about the next day. How you are going to invest,
Exactly
what type of environment you're going to face.
Yes.
Am I going to have a tariff?
Yes.
That type of thing is just killing so many organizations at the international level. And I'm not talking about the big companies that we talk about all the time. We're talking about smaller companies that just simply cannot survive with this level of ambiguity. And that's a problem for financial markets, obviously, because we don't have the understanding of how we can really come out with an instrument or a set of instruments that put us in that situation. So yeah, if you see it from that perspective, I mean, it's really hard to come out with something that allows any average company to deal with the type of uncertainty shocks that we're facing right now. Take since 2019, right? We have we have COVID-19.
Yeah.
We have a war in Europe that has continued. We have the war in the Middle East.
Yes.
We have a set of natural disasters that have been really, really disruptive in many areas of the world. And then, you know, if you think about your question of what is the role of weak institutions and in emerging markets, I feel that the question really is that what do you consider weak institutions in this setting, right? Because a lot of the uncertainty that we are seeing right now is coming from places that are highly developed, that arguably have institutions that should work in times like this. The reality is that we're facing a situation that we don't understand very well. So given that novelty, obviously we are going to have an issue to come out with a good strategy to deal with this type of problems.
And also just to add a quick follow-up, I mean, I think when, especially in recent times, like risk premiums have just been going up higher because of whether it's a war, whether it's resources being constrained. But I mean, also one thing you do see, I mean, maybe this is also unique to the current situation at the time. I mean, I would say maybe it's not considered an emerging market anymore, but AI use in actual market share has been going up and up and up. Do you think, like, especially at this point, that maybe people and institutions are maybe leaning more on the emerging markets that they've already found as a value of maybe consistent growth, or maybe going back to more consistent means of growth instead of looking at emerging markets? Like, do you think it really hurts when the risk premium, like times like this, just goes higher and higher? Do people shy away entirely from emerging markets, or rather kind of go all in or all out, if that makes sense?
Yeah, the question is still for me?
I mean,
I think what's going to happen is that I think maybe 30 years ago, it was more black and white. You just say, all right, this is how I'm going to play the emerging markets. I'm going to go after the BRICS. This is how I'm going to play the mature markets. I'm just developed markets, the US and Europe and Japan or something, or South Korea. Because, like how Professor Lewis had mentioned earlier, things have been flipped. So it's not as straightforward. So we have to be more nimble. And the only thing that's constant is change. So we maybe actually have to get deeper into the weeds so that we can pivot when it's necessary and put together the right structure. We're putting our capital there, but we want to be mindful. Okay, now we're analyzing things even more deeply, because in many respects, some communities are saying they're not into globalization, but we notice that there's a lot of interdependence. So, okay, so now the tariff is hitting China, so maybe they're gonna loop it through Mexico, they're gonna loop it through Indonesia or different places. So it's really, really more important that you really start to peel back the onion and see what's going on, versus in the past it used to be so simple. Just go here and there, you can play that bet and ride it for the next 10 years, because we're like, China's gonna have 7%, 8% growth for the next 10 years, but no, it's interesting because Chinese growth is starting to slow down. So it makes it very difficult to just place one bet and just go away. You gotta really, really stay on top of it.
I'll move on to, we have a question for you, Kara, as well. Also from your perspective as an entrepreneur, where do you see the biggest gaps between capital availability and opportunity on the ground and in person?
I think what's so interesting, especially right now, so you have like in Africa, if you think about like, you start looking at some of the demographics or what have you, and we'll say like this large percentage of young people are in these emerging markets, or markets that's not developed. What happens if we can get them to become more of consumers, or we can make them become middle class or what have you? whether that's because of the institutional support or just because of AI or maybe because of exposure to what's going on in the world. And as investors, or people that's thinking about investing in these markets, you don't necessarily have to be a jack of all trades or a jack of all trades and a master of none. You can say, all right, this is the angle I think I want to play in this particular market, and I am, whether that's like, let's say it's still or what have you, and you're going to make the case to your out to the local, put a team together that's on the ground. So this is what I did in Philadelphia. I have my own property management business. I said, I'm going to put my team on the ground, and we're going to change the framework where we're not just going to do a background check and credit check. We're actually going to interview each person at their own personal residence so we can see how they live. So what I'm trying to do is I'm trying to change the framework that all the other landlords, they don't meet the people at their personal residence and all that stuff. So what you're gonna do is look in these emerging markets and say, I'm gonna go deeper and not just do a macro analysis, but you're doing macro and a micro. And we're trying to put people on the ground, but we're also gonna use the latest technology so that we can figure out what is gonna be our niche, because the riches are in the niches. So like when Airbnb came out and several years ago, a lot of people were saying, I want to invest in Airbnb, and I've been a long-term buy and hold investor for 17 years in real estate. My brother was like, even though I was successful, he said he wanted to do Airbnb. His returns were, let's say cash on cash returns are 70% when it first started. Then it went down to 50, then it went down to 20, then it went down to like 0 now in Philadelphia because they changed the local regulation. So now you can only have an Airbnb if that's your personal residence or you're an operator. So they make you pay an additional fee, so that ate up all their returns, because the local homeowners didn't like it, the long-term landlords didn't like it, and the hotels didn't like it, and the politicians didn't like it. So you have all these forces competing, and they destroyed that industry. But Airbnb works in different markets around the country, but I mentioned as an example how we have to be localized in our thinking to assess the dynamics of that market and the culture and the regulation, and then try to get a sense. So I knew that Pennsylvania is like a purple state, so I know that you're gonna have the liberals and Republicans going head to head, but they're never gonna put like rent control for the whole state. So I want you guys to use the same type of approach when you're looking at these different markets and say, all right, what can we do that we can make money over the next 10, 20 years? Because what happened is a lot of times we think about deploying that capital, we're short-term oriented. And we say, I wanna play this game for 3 years. No. And sometimes also we're so short-term oriented, we don't realize, we're like, oh, they're gonna have aid from the UN, Red Cross, or another country for 15 years, but that may change. So I think it's really important that we factor in the local dynamics, the culture, the regulation, the uncertainty, because the inefficiency, because that's where opportunity lies, and that's where you're gonna make your money. But don't spread yourself across. You gotta figure out what your niche is, because that you can spread the risk yourself. So say you have $5 million. You don't wanna go put all your $5 million in the emerging market. You wanna understand the market, be able to make a compelling story to outside investors, so therefore you can spread your risk so you don't get blown out or get caught flat-footed. So that's how I will approach it.
Thank you. Do you want to ask?
Yeah, sure. Omar, you've spoken publicly about the imbalance between climate mitigation finance and adaptation finance. How should that imbalance shape the next generation of capital allocation into emerging markets?
I think you're muted.
Yeah.
Okay.
Yes. Yes.
Now?
Yes.
Yeah. Just give me a sec.
Go for it.
Yeah, okay. You can hear me now?
Yeah.
Yes. 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 Perfect.
Okay. Well, I think the reality is that adaptation finance is chronically underfunded. The imbalance between climate mitigation and adaptation finance is it's an opportunity. I think it's a real signal for investors. Most capital is going into mitigation, which is like renewables and emission reduction, but far less into adaptation, which is what emerging markets urgently need to protect people, infrastructure, and growth. The gap creates both risk and opportunity. Risk because underinvestment in adaptation can lead to stranded assets or economic disruptions, Opportunity because investors who can structure financing that addresses adaptation, resilient infrastructure, climate smart agriculture can capture first mover advantages. In short, capital allocation should be increasingly reflect not on mitigation potential but resilience and adaptability. That's how emerging markets can grow safely and profitably in a climate constrained world. But the imbalance isn't just a market inefficiency, it's an alpha opportunity. Those who move first can capture risk-adjusted returns while also enabling development outcomes that makes the markets investable for long term. Well, in a world of climate shocks, the smartest capital isn't just low carbon, it is climate resilient. Thank you.
And I want to go leave a couple of minutes or a few minutes for questions for anyone in the audience. So before we switch to that, I kind of want to end on the moment we're all living through right now, like between geopolitical tensions, changing capital flows, and more uncertain global markets. It's clear that the path ahead for emerging markets is anything but straightforward and simple. And so in this environment, what gives you the most confidence? What gives you the most confidence about the future of emerging markets, and what worries you the most? Sorry.
Yeah, I don't know if that's playing against emerging markets, what you said, or is basically playing in favor of the emerging markets, and it's especially because it's developing opportunities in places that we normally don't consider, or where investors, used to think that the level of risk was so high that it was not worth it. But precisely because of geopolitical uncertainty, for instance, we are having a redesign of the lines of power, the alliances at the international level, and what you are going to see in a few years. It's not a matter of decades, it's a matter of years. We're going to shift more attention naturally to places that you are describing as emerging markets. That's a natural approach for investors. It's a natural approach for understanding opportunities at the international level. And you're seeing nowadays those type of shifts, right? You have Canada, for instance, trying to figure out who's the right partner if it's not the US, and then making a trade agreement with India. You have China investing heavily in Africa, and you have the whole Latin American region trying to figure out where the EU is going to be and figuring out where the other opportunities are at the international level. That is going to be really important to the way that we consider the nodes of power and where we consider the opportunities for businesses are at the international level. And that's something that it depends on how much we take that challenge nowadays. Like we're saying about seeing this from the perspective of there's a way to understand these challenging places as opportunities by rethinking about the way we were taught to figure out what opportunities are. And I try to convey that. I don't teach frequently, but when I teach, I try to convey that to my students, because it's not a matter of where institutions are developed right now. It's a matter of what type of institutions places have for things to work. And that's an important question, because we tend to have a stereotype and a paradigm that really creates bias or create bias to understand opportunities. We are going to evaluate institutions based on the institutions of the United States, based on the institutions of EU. That's not really the right approach nowadays. And who knows in 5 years who's going to be at the top of the GDP per capita, GDP growth. But chances are, given the trends that we're seeing right now, that are not going to be the usual countries that we are
Used to see
we have
growing fast.
seen
Yeah.
in these rankings for the last 20 years.
I agree 100%. And I always go back to like of course I did international work, but now as a owner of 160 plus rental units, it's interesting because you can look at things the traditional way. Like 17 years ago, I used to be able to analyze a potential tenant do a background check and just do a regular check and say, and then we got to the point where I had to say, oh, now I need you to give me your pay stubs. And the other thing is I said, I need you to give me your bank statements. But then we got to the point where, like last year, we saw a lot of fraudulent activity, that they were making up those, your ID, your pay stubs, your bank stubs. We didn't have that issue 17 years ago. So therefore, I have to come up with, now I'm using fraud detection AI software before I even accept these tenants. But I also do something different where I'm also going into their houses. I won't interview you at a McDonald's, had to be at your ID, that's on the address on your ID, and also meet with the pets and everybody. And we also want like not just 1 month, we want 6 months of bank statements. So I give you that concrete example to say it's going to be the same way, because now we're looking at these markets, and from the macro level, things are so much uncertainty that you can't just say, oh, the United States has said they're going to invest in this country, and Canada said that they're going to be a partner, because now we're just throwing away our trade agreements every couple of years. Back in the day, if the U.S. and the government, they would stick to it for like 10 years, stick to it for 20 years. But now what we have to do is approach these different markets, understanding that the dynamics have changed, that we got to really roll up our sleeves in order to make money from these different situations. So I think that is, if you can figure that out, you're gonna make a lot of money by being willing to adapt to the current situation and change. What's so important is that you have to, a lot of people have put capital to work, and where they go wrong is they have no structure. So whatever you do, make sure you have a framework and a structure that you apply on a regular basis, even if you're updating it, versus just shooting from the hip.
Omar, you want to talk a little bit about how this is kind of seen in a diplomatic level. Oh, I think you're muted
Sorry,
again.
you're muted, yeah.
Oh, sorry. I think you're muted again. No worries.
You're gonna have to get a lip reader in here.
Oh, sorry.
No, I'm really sorry. You know, it's sometimes I'm having a tough time trying to understand what is being discussed also.
Oh.
But however, do you have a question, or do you want me to add my comments to what was discussed?
Yeah, I was kind of just wondering. I mean, you have definitely a different perspective than KR and Luis. Kind of from a diplomatic level, like in this environment, in your aspects, how do you think, like, what gives you confidence in future emerging markets, and what's kind of maybe doesn't give you confidence or kind of worries you, at least in?
You see, diplomacy plays a very critical role in turning potential investments into predictable and sustainable opportunities. Cross-border capital often hesitates because of political uncertainty, trade frictions, or regulatory ambiguity. Strategic diplomacy can reduce these barriers through bilateral agreements, trade facilitations, and clarifying investment frameworks. More than that, it can actually help a market as a trusted partner in global supply chains, giving investors confidence and their capital can flow, perform, and be repatriated safely. What I'm saying is, in short, diplomacy doesn't just smoothen relations, it de-risks investments and unlocks long-term scalable capital flows. For me, you know, the best diplomacy isn't about politics, it's about creating confidence that capital can operate safely and sustainably. Thank you.
Thank you. Thank you. I'll open it up for I think we have time for a couple of questions, if anyone. Yeah.
Well, thank you very much for speaking and sharing your knowledge and experience. My question was relating to international trade networks. The US recently backed out of 66 international organizations. It's moving towards this US isolationist, or as Omar said, it's selective globalist policy. I mean, Luis, you mentioned China and Africa having more trade deals, LATAM merging with sort of aligning with the EU, and Canada and India trading. What I'm seeing is the world is trying to separate itself away from a US centric position where it's the US and now the rest of the world, with China being the key player investing in moving capital around. So my question